Ladies and gentlemen, good day and welcome to Tinna Rubber and Infrastructure Limited Q1 FY26 earnings conference call hosted by Go India Advisors LLP. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Sana Kapoor from Go India Advisors LLP. Thank you, and over to you, ma'am.
Thank you, Arshi. Good afternoon, everybody, and welcome to Tinna Rubber and Infrastructure Limited earnings call to discuss the Q1 FY26 results. We have on the call Mr. Gaurav Sekhri, Joint Managing Director, Mr. Subodh Kumar Sharma, Director and Chief Operating Officer, and Mr. Ravindra Chhabra, Chief Financial Officer. We must remind you that the discussion on today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risks that the company faces. May I now request Mr. Gaurav Sekhri to take us through the company's business outlook and financial highlights, subsequent to which we will open the floor for Q&A. Thank you, and over to you, sir.
Good afternoon, Sana, and thank you. Thank you for joining us today for the Q1 FY26 earnings call of Tinna Rubber and Infrastructure Limited. Our financial results and earnings presentation are available on our website and on the stock exchanges. I believe you have had a chance to review the same. I will briefly take you through the strategic updates, post which my colleague Subodh, our COO, will take over and give details about the operational and financial performance highlights for the quarter. I am pleased to report that Tinna Rubber has demonstrated improved performance in Q1 FY26 on a quarter-on-quarter basis, despite facing challenges arising from the early onset of monsoon and prevailing global headwinds. On quarter-on-quarter basis, our EBITDA increased by 19% with a 344 basis point improvement, while revenue and PAT remained stable. Coming to some strategic updates, we successfully completed our maiden QIP in July 2025, raising approximately 79 crore from marquee institutional investors, including ICICI Prudential Mutual Fund, JM Financial Mutual Fund, and Bank of India Mutual Fund. Deployment of QIP funds has commenced from Q2 FY26 and will be allocated approximately as follows: 23 crores towards debt reduction, 12 crores, for solar power expansion, and 22 crores for a new plant of recovered carbon black, and 19 crores for general corporate purposes. Tinna marked a key milestone with its successful NSE listing in April 2025, complementing its BSE presence and reinforcing our commitment to greater visibility in Indian capital markets. Coming to our cost reduction initiatives, the reduction in debt will lead to annual interest saving of about 1.5 crore. We are expanding the existing renewable energy to more than 3 times from the current capacity of 1.26 megawatt to 4.52 megawatt. This will lead to total savings of 3 crores annually, and approximately 50% of our power needs will be met through renewable sources, including captive solar and some third-party purchases, aligning with the company's ESG goals. Also, with increased optionality on using different types of tires as feedstock, we expect cost savings of 10 to 15%. In Q1 FY26, we have incurred capital expenditure of approximately 13 crores, and we are committed to our plan of approximately 100 crores of capex over 2 years. I am pleased to inform that we have monetized approximately 5.6 crores from non-core assets, which were at 28 crores at the beginning of the year, and the company will continue to actively pursue monetization of the remaining non-core assets. Providing a brief overview of projects, the polymer composites business during the quarter and in the master batch business, we have reached sales of 100 tons per month, reflecting steady volume growth. The product portfolio was expanded to include color, additives, silicone, and biodegradable master batches, further strengthening our presence. We are actively working on specialty master batches designed to improve technical performance and yield better margins, aligning with our goal of sustained profitability. The Varle plant capacity utilization increased from 30% in Q1 FY25 to 57% in Q1 of FY26, driving a significant year-on-year sales growth from approximately 6 crores to 27 crores. Turning to our international projects, in Oman, the plant operated at 85% capacity utilization, generating around 1 million in revenue, and 35% of our output is now sold within the GCC region. In Saudi Arabia, we have received allotment of 20,000 square meters of land, and we hope to commence building the facility soon, and we are hoping for commissioning to happen from Q4 of 2026. Tinna has successfully infused capital into its joint venture, Bodla Investments in South Africa, where we have received consent to receive and export 24,000 tons of end-of-life tires, which will be used as feedstock for our plants in India as well as Oman. The phase 1 of operations have already commenced in Q1 of 26. In conclusion, I would like to emphasize that we are firmly on track to achieving our Vision 28, expanding our presence from 6 to 10 locations, targeting revenue CAGR of 25% to reach 1,000 crores of revenue by FY28, with a targeted EBITDA of 18% plus and ROCE exceeding 30%. With that, I would like to hand over to Subodh for his insights and comments on operational and financial performance. Over to you, Subodh.
Thank you, Gauravji. Am I audible? Moderator?
Yes, sir. Please go ahead.
Thank you. So, coming to operational performance, in Q1 FY26, tire fishing volumes declined due to slowdown in infrastructure and consumer segment. Regarding FY26 Q1 segmental performance, the industrial and steel segments delivered revenue growth, while the infrastructure and consumer segment faced a temporary slowdown. Revenues from the industrial segment have grown by 15% on YOY basis. Despite global economic headwinds, export performance in the industrial segment remained positive, supported by stability in the rubber conveyor and molded goods industry. The steel segment recorded an 8% YOY revenue growth, though overall growth was a bit curbed by declining steel prices driven by low-cost steel scrap import from Russia and other countries. The slowdown in infrastructure sector was driven by delayed fund releases from Ministry of Roads, an early monsoon, and supply disruption caused by the Israel-Iran conflict, which impacted bitumen exports from Iran, a key supplier to India. On a positive note, the bitumen emulsion business recorded approx 40% year-on-year volume growth. We are confident of a strong rebound post-monsoon driven by a solid and growing business pipeline. Consumer segment demand is expected to revive in the upcoming quarters following a seasonal shift influenced by early monsoon and short-term market liquidity adjustments. Coming to consolidated financial performance for Q1, revenues stood flat at QOQ basis, whereas it declined by 4% on YOY basis, primarily due to lower EPR contribution of INR 4 crores in Q1, compared to 10.5 crores in the corresponding quarter of FY25. Our gross margins improved by approximately 344 basis points on quarter-on-quarter basis, driven by lower raw material costs, operational efficiencies, and stronger sales realization. Our EBITDA increased by 19% QOQ basis to rupees 21 crores, and margin stood strong at 16% and improved by 237 basis points on quarter-on-quarter basis. Our PAT remained flat on quarter-on-quarter basis to rupees 12 crores, and PAT margin remained robust at 9%. At the console level, Global Recycle LLC, our associates company operating from Oman, and PP Buildtech contributed INR 0.4 crores and INR 0.7 crores respectively to PAT level. I am happy to share that our working capital cycle has improved from 42 days in FY25 to 38 days in Q1 FY26, reflecting our unwavering focus on operational efficiency and financial discipline. Tinna Rubber is making strong progress towards its Vision 2028, driven by strategic capacity expansion, capital investment, global sourcing, and business integration. Its diverse product portfolio and international focus and experienced leadership, supported by committed stakeholders, position the company for sustained long-term growth. I would now like to open the floor for questions and answers. Thank you, and over to you, moderator.
Thank you, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mr. Akshay Shah from Toro Wealth Managers LLP. Please go ahead, sir.
Hello, sir. Thank you for the opportunity. I have 3 questions, sir. Is the issue of Red Sea disruption sorted in Q1 FY26, or did you still have to face impact of the same?
Can you repeat what disruption?
Red Sea disruption.
So I didn't get the word. What kind of disruption? Sorry?
Red Sea. Hello? Red Sea disruption?
Red Sea?
Yes.
Red Sea, okay. Yeah, thanks for the question. There is a certain amount of settlement that has happened in the way the trade is being conducted. There is some normalization, I would say, and the whole logistics industry has kind of gotten used to it and settled around it. The freight rates are also stable, so that's what I can tell you. They haven't gone up.
Okay. So my second question is there any impact of Trump tariff policies on your company? And if yes, request you to please explain and how do you plan to safeguard yourself?
Sure. We actually have very little business with the US. So to that extent, we don't see any impact on us.
Okay. And sir, are QIP funds sufficient for your capacity expansion plan of solar pyrolysis and recovered carbon black plant?
Absolutely.
Okay. And sir, what are your plans on the debt front? Do you have any threshold in the mind above which you won't go in terms of total borrowing?
Well, we are currently very comfortable with our debt profile. We have scope to take more, but we don't see any immediate need to take any more funds in debt. We don't foresee it.
Okay. Thank you so much, sir, for answering my question. I will come back in the future. Thank you.
Thank you. Participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. I repeat, participants, If you wish to ask a question, you may press star and one on your touchtone telephone. The next question is from the line of Mr. Deep Mehta from Bank of India Mutual Fund. Please go ahead, sir.
Hi, sir. Thank you for the opportunity. Couple of questions. First, in Q1, if I adjust your margins with EPR credits, we have seen sharp improvement in overall margins. So what led to improvement in margins, and is this higher margin sustainable going ahead?
Hi, Deep. Gaurav here. Thank you for the question. Yes, your analysis is correct. The improvement in our overall margins has happened right from the gross margin level, where we have seen a 300 basis points plus improvement, and we believe at this stage it seems sustainable. I don't see any reason for that to change.
And what led to this improvement in margins, if you can share?
Well, it was a combination of things. Primarily, we brought down our cost of raw materials by increasing the optionality of the kind of tires we run into our facilities. That helped us. Also, higher sales of crumb rubber modifiers benefited for us as well in margin improvement.
Very clear, sir. And my second question is regarding our PCMB business. As you have said in your presentation that capacity utilization has improved to 24%. If you can give us some qualitative color about this business, how do you see the capacity utilization going ahead? How many clients have we onboarded? Is the product profile at par with clients' expectation, both in terms of quality as well as pricing? If you can talk about that, that can be very helpful.
Sure. No, excellent question. Again, on the PCMB business, while we have now reached a steady state of about 100 tons of sale, but our ambition is far larger than that. We are at early stages of trials, bulk trials, initial supplies with various customers across different sectors, and we are confident that in this financial year we are expecting approximately 30 to 35 crores of contribution in our overall top line from the PCMB business. And once that is achieved, that will lay the foundation, to further expand that vertical. So that is where we are at. So we are keeping ourselves very focused at this point of time to get as many approvals in marquee clients and industries to enable us to get to our target for this financial year.
Great, sir. And my last question is just a bookkeeping question. If you can help us with the number of EPR credits which we are holding as on Q1 ending, if that can be very helpful.
We will get back to you on that. We'll get the data out and we'll get back to you.
No issues. That's all from my side. Thank you and good luck.
Thank you. Participants, if you wish to ask a question, you may press star and one on your touchtone telephone. I repeat, participants, if you wish to ask a question, you may press star and one on your touchtone telephone. The next question is from the line of Mr. Mihir Vora from Aquarius Capital. Please go ahead, sir.
Yeah, hi, Gaurav. So basically, sir, just one clarification. In your opening remarks, you mentioned that there was a 10 to 15% cost reduction by using this different kind of tires. So maybe you can just extrapolate it a bit. That is the understanding correct, that previously it used to be TBR, now getting into PCR also, or you have changed something into your machinery in that sense?
So, thank you for asking this clarification. We were largely a TBR recycling business, and of course, after that, PCRs were added as well. We have now enabled ourselves to also recycle off-road tires like agriculture tires and mining tires. So, combination of all of these three is what is helping us to get a reduction in our raw material cost.
And so the off-road tires, basically, is it into the existing machinery only, or we have added some machineries to that?
We've added some equipment. Because these off-road tires can be very large. An individual tire can be half a ton. So it needs different treatment.
Okay. And so my second question was on this PCMB business. So just wanted some highlight on the nature of this business, whether this will be a order book driven business or is it some kind, spontaneous orders? How does it work?
No, this is very much a order book kind of business. The large, just like any other business, this has elements also of some, sales into the, more spontaneous sector, as you called it. But to a large extent, it follows a very similar process of getting approvals of your product from large auto component companies, other organized players, which is a process. But once that is done and achieved, then one develops a fairly high visibility of sales.
Okay. And so in terms of this year, maybe, the approval process for the OEMs also would be sort of elongated. So this year, would it be correct to assume that this would be more of a spontaneous business than to a order book, or then it starts building up, say, going towards the next year, start getting few orders into this? How will that trajectory go for the PCMB business?
You're right. While we are at different stages of approval with OEMs, etc., it is the more sort of the resale market, replenishable market which we are trying to cater at this point of time, while we get approvals from other clients. So you're right. Your assumption is correct.
All right. And sir, finally, on this margin target which we have set for ourselves, that is 18% by FY28. So first thing here is that because you are getting into the newer segments like PCMB and pyrolysis also, which will still be at a nascent stage. So what are we seeing there that we are, is thinking about achieving that 18%? So how this margin trajectory will play, because, into the newer segment, we face some competition also. So how are you, planning to manage that?
See, we've done our, forecasts, and that is why we feel confident to give that as a guidance. At this point, we've achieved 15.5%, EBITDA margin in Q1. And, at this point of time, whether it is the PCMB business or the setting up of the regenerated carbon black business, these are new initiatives where a lot of costs are incurred front end, and the result comes a few months or quarters down the road. Similarly, in our international operations, we are in investment stage in stabilizing South Africa, Saudi Arabia, etc. So these the benefits of this work will be seen over the next few quarters, but the expenses are being incurred today. So as they stabilize, that will enable our EBITDA to go up, and of course, operational efficiencies will kick in as well.
Sure, sir. Thank you. That's all from my side.
Thank you. Participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. The next question is from the line of Mr. Kushal Kasliwal from Invade Research. Please go ahead, sir.
Yeah, hello, sir. So just wanted to understand your realizations in pyrolysis and recovered black carbon. We are doing this capex and entering into this new business. So, can you indicate possible top line, bottom line estimate, margin estimates, and realizations here?
So the regenerated carbon black business is, at the moment we are in the process of placing orders for the plant and the equipment, etc. A lot of the civil work and the building work is more or less complete. So that is the stage we are at. In terms of the margin profile of this business, we expect it to operate at very similar margins as our existing tire recycling business. Similar kind of margin profile is there. But, we will be able to tell you more surely when we begin and start, which is expected to happen,
Q4.
End of Q4, maybe early Q1 is when we will start seeing this facility becoming operational.
Okay. So just for my information, what kind of asset terms can be expected here?
It's approximately 3x, again, very similar to our existing business.
Understood. Got it. Fair enough. Sir, on the industrial business side, we obviously saw a significant decline. Infrastructure segment. Any particular, I mean, obviously you have highlighted some reasons, but are these issues out now? Were they temporary? How are you experiencing 2Q? I mean, what has been your experience in July, maybe? If you can just, spell that out.
Yeah. Hi, sir. This is Subodh here. So on this side, Q1, it's very unlikely, the monsoon started quite early this time, and we are also, keeping an eye because the business pipeline is strong, and we are anticipating, the business will come back on the track. So Q2, at this point of time, it's very difficult. We expect it to be finished off by, early September. So the things should come back on the track. That's what we feel on the infrastructure segment side.
Okay, so you're saying September is when you think things will become normal, till September. So Q2 will also be weak.
Yeah.
Understood. And same question on the consumer side. I think we have, again, there is a temporary decline of 10%. Can you also tell about Q2 there, consumer segment?
Q2, and I think this already started picking up because certain application wherein we were struggling to get approval in the Q1, and that finally are in place. So that already started picking up from Q2 onwards. So you will see some growth in the consumer segment from the Q2 itself. But the road business is again, it's just a break of this monsoon period. This will further kick in back, and we expect it to come back on the track from by end of Q2, we believe.
Understood. Thanks. So my last question on the Varale capacity utilization of our Varale plant. So this is now around 57%. So what kind of top line can we expect overall in FY26 from this plant, and overall capacity utilization for FY26?
You see, Varale, when we set up, if you see, it is growing, and consistently since last 2 quarters, it is operating at around 55-60% in between capacity utilization. We have always maintained once it reaches its, optimum, so it can generate close to 100 to 120 crores kind of top line. Without adding the new initiatives, what we have taken in the current financial year, that will further be added once that come into the operation.
So on an annualized basis, what can be a ideal capacity utilization number?
See, this year we expect it to be around 80 to 90 crores kind of top line from Varale alone with the existing kind of product portfolio. But going forward, once we see stabilizing our, RCB and Pyro, which we are not taking into the account, that will start contributing from the next financial year. It is completely, as of now, we cannot predict anything that we are targeting by Q1. We wanted to start, but if everything's fall in line, so that will further add something to the, the Varale overall revenue.
Okay, so I'm assuming 85-90 crore at the same 60% kind of capacity utilization, right?
Yes, sir. Yes, sir.
Okay, got it. Thank you. Thanks.
Thank you. A reminder for the participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. The next question is from the line of Mr. Kedar from NAN Partners. Please go ahead, sir.
Yeah, so thank you for the opportunity. I've just recently started tracking your company, so forgive me if my questions are very basic. So firstly, on your sourcing part, so it's mentioned that you, in a previous con call, that you import 70% and 30% is domestic. So on the import side, is it mainly from the tire manufacturers or is it from the dealers?
Hi, this is Gaurav Sekhri. See, each country is a little bit different. Some countries have the collection of end-of-life tires is done through scrap traders, etc. So we work with such entities. In some countries, there are producer responsible organizations which are organizations formed by tire manufacturing companies, which ensure efficient collection, and it is their mandate to ensure environment-friendly recycling. So we work with those as well in countries where they are set up. So these are sort of the ways we operate.
Okay, understood. And on the import side, like, is it skewed toward imports because of lack of availability in the domestic market, or is there any other reason? And what is the difference between imported ELT and a domestic ELT?
See, in terms of quality, etc., there is very little difference. In terms of landed cost basis, because 3 of our plants are located at ports, we find it more economical to work with imported end-of-life tires in most instances. So that is why the 70-30 ratio, as well as the collection, the volume that we need is easier for us to aggregate from imports. Of course, we like to use as many domestic tires as possible, but here there is no organized collection yet. It is happening, and certainly implementation of EPR is enabling that. We see that with progress of time, our dependence on imports will reduce.
Okay, understood. So, like, over the next maybe 2-3 years, you will see domestic procurement increasing because of the EPR policy. Can you give, like, any guidance, like 70-30, say how much it will be?
I think, and I'm just guessing here, over next, maybe after 2-3 years, it could become, 60-40, possibly in favor of domestic. That is possible. So, we will see.
Okay, understood. And secondly, on the, like, I had a hypothetical question. So if companies like tire companies, like say MRF, if they decide to build up their own recycling operations, since they have the scale and they would have the end-of-life tires, so can they not be a competition for you in the future? Or what is your view on that?
We have not seen any tire manufacturing company globally, and there are many large international companies which are even larger than MRF getting into tire recycling. It is not really their core activity. So for that reason, I don't see that happening in India either. And I believe a big challenge for tire companies is that their own use of recycled rubber is very limited. They will use maybe 10% or 15% in their overall compound. So for them, just to recycle tires so they can use 10-15%, and the balance steel they have to sell, fiber they'll have to sell, rubber also they'll have to sell to other industries. It is just not their core area of competence. So I think that is why we've not seen any tire company anywhere in the world getting into recycling.
Okay, got it. Yeah, thanks for your views. Then secondly,
Mr.
on your
Kedar,
margins.
I'm sorry to interrupt. Mr. Kedar, could you come back again in the queue, please?
Yeah, sure.
Thank you so much, sir. Thank you. The next question is from the line of Mr. Dipesh Sancheti from Manya Finance. Please go ahead, sir. Mr. Dipesh?
Yeah, can you hear me?
Yes, sir. Please go ahead.
Yes, Dipesh, sure. Please go ahead.
Yeah. Okay. Hi. I've joined the call a little late, so if there is any repetition of questions, please you can skip that. What is the trend of the scrap price in Q1 FY26, and how do you see this happening? I mean, how do you see the trend in Q2 till now?
See, end-of-life tire landed cost to us, we have created some efficiency in reducing our cost by increasing optionality of different kind of tires we use. But at the moment, we are seeing a bit of a downward correction. So that is where we are at right now.
Okay. So, and you have mentioned in your PPT that you are planning to setting up the pyrolysis and recovered carbon black plant. Can you please let me know the location where you are planning to set up this plant and the payback period for this project? And by when can we expect that to commission?
The regenerated carbon black plant is being set up inside our existing facilities at Varale, where we already have a passenger car radial recycling plant in the same complex. We expect to begin sales possibly from end of Q4 of this financial year. And in terms of margins achievable, we expect to operate at around 15 to 16% EBITDA margin, very similar to our existing material recycling facilities.
Okay. And how much top line do you expect from this?
We expect approximately in full capacity utilization, probably around 70 odd crores a year.
Okay. And the PCMB business has a capacity utilization of 25% roughly. By how much do you expect the same to increase by FY26, end of FY26? And on an average, what approx will be the utilization in FY26 and going ahead?
We expect to get to about 60% utilization by Q3, from Q3 onwards, in the PCMB business. And we expect its top line contribution to be approximately 30 crores, which was almost negligible in FY25.
Okay. And do you expect that this will actually contribute about 5% of your top line going ahead?
Very, very much so. Possibly larger, because this is a very small pilot plant that we've set up. If our business model is validated, we will plan a ramp up very quickly in this. So the contribution to our overall top line, could be 5, 8, 10%. I mean, that's very hard to predict today.
Okay. And how fast can you ramp this up? I mean, if this thing turns out to be successful, and how much capex will you require for that?
Again, it's very early stages, really speculation. But in terms of ramp up, the period is under 6 months. I mean, the learning that we are getting now, I believe that, from decision making to getting something started will be about a 6-month process.
Right. Right. And where do you see the ROE expectations? I mean, we are having a very good ROE, but right now, where do you see ROE? What will be a decent ROE expectation we should keep? Right now, last year you were at around 32% ROE.
Yeah,
do you expect similar?
It's a fairly healthy ROE. We are happy with that, and we expect to continue to maintain it. Is what we can tell you today.
Great. All the very best, guys. Thank you.
Thank you.
Thank you. Participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. The next question is from the line of Miss Maitri Shah from Sapphire Capital. Please go ahead, ma'am.
Hello, am I audible?
Yes, ma'am.
Yes. Please go ahead, Maitri.
Yeah, most of my questions have been answered. Just one question on the revenue target for this year. So, are we still on the trajectory of growing 25% YOY FY26?
Yes, very much so. We Q1 and Q2 in top line is always a little weak for us because our infrastructure vertical usually is a bit slow in these quarters, but we are maintaining our guidance of 600 crores plus for this financial year.
And for the margins, are we targeting around 15 to 16%, or we could go a bit higher for that?
We had indicated that we are working towards 15.5% EBITDA margin, which we have achieved in Q1. I expect for us to maintain this in this financial year.
Okay, thank you.
Thank you, ma'am. The next question is from the line of Devi Agarwal from FECOM Family Office. Please go ahead.
Yeah, hi sir. Thanks for taking my question. So, sir, I just wanted to know about the capacity for the RCB and pyrolysis plant.
100 TPD. Yeah. Hi, sir. This is Subodh here. So, we are, putting up the capacity of 100 TPD of feed for the RCB and pyrolysis. So, 100 TPD of feed means it can generate around 40 tons of oil and approx 35 to 38% is the carbon black.
Sure. So that was helpful. And can you break up the CapEx part of it? What would be the CapEx for pyrolysis and RCB?
See, out of this, like we mentioned, we have successfully, closed the QIP. So out of QIP, we have allocated around 23 crores for this project. So that is, started being disbursed, and the project is very much online, and we expect it to be started by end of or mid of Q4 FY26.
Actually, sir, I just wanted to know the bifurcation between the CapEx of RCB and pyro.
This is a turnkey project basis we are working on, sir. So we have taken everything combined together, and we have allocated the budget accordingly.
Sure, sir. And in terms of competition, so what should be like one of the listed players also entering into the pyrolysis and RCB segment. So what, according to you, would be the competition, and what is the total addressable market in India and globally if you want to export as well?
Hi, this is Gaurav Sekhri. See, in terms of competition, there is enough competition in everything in India. Even in our material recycling business, there are so many more plants. All the businesses, have fairly high degree of competition already. But the differentiator is in how one creates efficiencies by scale, by having diversity of raw material, by having ability to use some of the end products in-house, etc. So those are our key levers and the differentiators. How our model is differentiated from others.
Right, sir. And in terms of the total capacity that you expect to be sold in India and abroad, what's the total addressable market for us in terms of RCB and pyrolysis?
The market for RCB is changing very dramatically. So far, the use of RCB has been low because of, the quality of RCB itself has not been up to scratch. With the new technologies that are now available, and that is why we also waited all these years and only now are setting up a plant, because now the technology is scalable, it is environment friendly, and the quality of product that it has the ability to make, the inclusion rates are very high, even in high performance products like tires and other compounds. So that is what has attracted us, and we are in that way, even though we are late entrants, I think, in the RCB business, we are probably better off because we have access to better technology.
Any quantitative number that you want to put in terms of tons or in terms of the percentage penetration in tires?
No, at this point it will be speculation. We wouldn't want to get into that.
Sure. And lastly, sir, I just wanted to know about the EPR income of 4.1 crores that we have recognized in this quarter. So this is mainly from MRP and reclaimed rubber, or this is from drum rubber as well?
It is from a combination of products. The EPR credits are based on the product that we make. All the products we make are all eligible for EPR credits. Some months, some product is higher, and that variance happens. But all the products we make generate EPR credits for us.
Sure, sir. Thanks and all the best.
Thank you.
Thank you. Participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. The next question is from the line of Mr. Chidananda Mohanty from Green Portfolio. Please go ahead.
Hello, sir. I'm audible?
Yes.
Yes. Please go ahead, sir.
Okay, sir. So the first question from my end. So let me tell you the paragraph, then you can tell me that if I'm doing the right direction or not. Food we are processing 100 metric tons of ELT. That means we would get 75 metric tons of rubber and 25 metric tons of steel. Am I following you? Am I going right?
Your voice is very muddled. Sana, moderator, can you please just check the audio on the side of Mr. Mohanty?
Yes, sir. Mr. Mohanty, could you come again, please?
Now, yeah, now I am clear. Am I audible?
Yes, sir. Yes, please go ahead.
Okay. So let me tell you one thing, that I am going to recite you a paragraph. So on the basis of that, you please tell me if I am on the right track or not. So if we are processing 100 metric ton of end-of-life tires, that means we are getting 75 metric ton of rubber and 25 metric ton of steel. If I am following it?
Yes. In case of radial tires, you are correct.
Right, sir. Now we have 75 metric ton of rubber, and it can be processed further in 4 different subcategories. Reclaim rubber for tire industry, rubber for consumer products, rubber for bitumen industry, and rubber for pyrolysis. So once we consider the pyrolysis plant is live, in which of the segment most of the rubber processed would be going into, and what kind of margin we can expect from that subcategory?
Mr. Mohanty, we have created optionality for use whichever area gives us the best margins. You are absolutely right. Everything starts with a tire, and from tire you get rubber. Now that rubber, I would be happier making most of that rubber into MRP, because that is a higher value product. Very few people have the technology and gives the best margins. But that is not possible, because its demand is also limited. So you also use your rubber for reclaim, you use your rubber for crumb rubber modifier for roads, and now we will also use it for putting it through the pyrolysis process and eventually making regenerated carbon black. But it is economics at that point of time which will drive focus for us.
Right, sir. So the next question from my side is that we expect by the end of by the end of calendar year 25, the government regulation about 100% ERP would be live. So what kind of top line percentage or what kind of amount from ERP you can assume or you can see after the 100% contribution is live from government side?
Sir, the government has set a range, a minimum support price of sorts for the EPR credits and a maximum price. At the moment, EPR credits are trading at the minimum support price. Now, if the demand exceeds supply, then the price will go up, and government has allowed for that. But that is a market-driven, outcome, and we don't want to speculate, and we cannot speculate on that today.
So, can you give the minimum and maximum support price for ERP?
Minimum support price is approximately 2,500 rupees per unit, and the maximum price is approximately 8,400 approximately per unit.
Absolutely correct, sir. Sir, the last question from my side, that in previous con call you mentioned that the steel abrasive segment can see strong demand from defense segment. But in this presentation, you rightly mentioned that due to low demand in segments like automobile, if the realization in steel abrasive has been low. Can you draw some correlation between both of them? That is, one side it is defense industry and other it's around automobile.
Yes, sir. It has very high opportunity from defense sector, because a lot of defense equipment, etc., is steel based. For steel surface preparation, our steel abrasives are used. But the reality at this point of time is, because of the slowdown of our core business, which is catering to the steel industry, auto industry, our sales have also been subdued in the steel abrasive business. And that is what we have presented.
Okay, right, sir. I will join back the queue. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Mr. Suresh Pal from KRSP Capital Limited. Please go ahead, sir.
Yeah, thanks for the opportunity, sir. in last few quarters, there was pressure on our margins due to several reasons, like freight cost has went up due to Red Sea issue. Then we were facing raw material cost rise. So I would like to know a qualitative review of yours. How is the situation right now in terms of those headwinds that were causing margin pressure? That is my first question.
Hi. We had stated earlier that, we have seen almost 300 basis points improvement, 344 basis points improvement in our gross margin, and that has largely been because of the correction in raw material prices, also our buying efficiency by increasing different options for our company. So we have achieved better cost margins. As a result, our EBITDA margins on an isolated basis without EPR credit has also improved.
Sir, that is your credit that you have got better opportunities for purchasing raw material. But your earlier sources, how is that situation? And what I want to know is you are purchasing the end of life tires from some places. Has those prices come down, or it is because you have proactively taken action, that's why the margin has improved, gross margin?
It's both.
Okay, both. And sir, my next question is, to previous participants, you have given FY26 revenue guidance. Can you please repeat that guidance, sir?
Our revenue guidance for FY26 is 600 crores plus, while maintaining our EBITDA margins at 15% plus.
Okay, sir. And can you please give segmental revenue breakup for quarter 4 of FY25?
You want segmental breakup of Q4 of FY25?
Revenue. Yeah, Q4.
You can send us a mail, sir, and we can reply to you by email.
Okay, fine. Thank you, sir. That's all from my side.
Thank you.
Thank you. The next question is from the line of Mr. Pratham Rawal from Master S. Chetan Private Limited. Please go ahead, sir.
Hello, am I audible?
Yes, sir. Please.
Yes, please go ahead.
Yes, so most of the questions have been answered. My question, just one question is there. Do you see any visible shift by the tire manufacturers on using recycled rubber for their manufacturing process? As there were safety concerns related to it, that manufacturers are saying that the recycled rubber are not safe for the use for manufacturing. So is there any visible shift you are seeing?
See, the tire industry is, with their sustainability drive, they are, very actively pursuing and, trying to increase their dosages in their system. In fact, if you see many of the annual reports from these tire companies, their ambition is by 2030, they want to use at least 10% of recycled rubber material in their system, which as of today is close to 3 to 5% only.
Okay, sir, that answers my question.
Tire is always, safety concerns and other concerns are involved. So this is a process. I mean, nothing is going to change immediately, but it's a process, and they are, focusing to increase the usage of recycled rubber material, sustainable raw material like RCB, regenerated steel, etc. So overall bucket they are improving, and going forward we see there's a lot of potential to supply the recycled rubber material to these companies.
Okay, sir. Thank you.
Thank you. The next question is from the line of Mr. Kedar from NAN Partners. Please go ahead, sir.
Yeah, thanks again for the opportunity. So my question was on margins. So I compared to one of your peers, GRP Limited. So their margins are much lower and, they are a lot more fluctuating compared to Tinna. We wanted to understand, what is the reason for that? Is it some process or technology or any sourcing advantages? So can you throw some light on that?
We won't comment on our competition. I think that is, I request you to please do your own analysis. We can only comment on our business, and I think in our earlier round together, I've answered you most of your questions. If you have anything more specific on us, then you are welcome to ask, please.
Okay. So, on your margin fluctuation, so what leads your margin higher or lower? Is it the scrap prices or rubber prices, or is it energy cost? Like, what is the major factor in your margin movement?
Major movement, margin movement for us is on account of raw material cost. Sometimes, because freight is a component in it, and it has a few other variables at play as well. As far as manufacturing costs are concerned, it's a fairly stable and predictable, cost structure for us.
Okay. So correlation to rubber prices would be lesser as compared to ELT prices?
No, we are not really linked to the prices of natural rubber, if that is what you're implying.
Yeah.
The market for end-of-life tires and the price or, of it and the cost of bringing it to our factories, that is not connected to natural rubber prices at all.
Okay. But how is your, like this CRMB or other products that you sell, that is benchmarked to what price?
Again, CRMB, there is no benchmark to anything as such. It's a unique product in itself. What helps the business is, because it is crumb rubber modifier being blended with bitumen. Now, if bitumen prices are high, then by addition of crumb rubber, you are actually making the product more economical. You're not only making a better product, but you're also making it more economical. So that then helps us with our demand.
Okay. Okay. So there is no, while fixing
sorry
the price
to interrupt.
to...
Mr. Kedar, could
Yeah.
you come again in the queue, please? We do have another participant in line.
Okay, just clarification of this particular point, then I'll be done with my questions.
Okay, please go
Is
ahead.
it okay? Yeah. So basically, I wanted to know, like, how is the pricing fixed for your products? Like, if you're going to sell to a particular company, then on what basis is the price decided?
So we operate in various sectors, as you know, and each sector has its own, pricing dynamic. In terms of when we are pricing products for the industrial sector, which is, let's say, the tire companies, etc., they take their overall compound cost into play, and by adding our materials, they see, how is that helping them with their sustainability goals. At the same time, of course, they are always motivated to save costs, and then they make their own recipe. And that enables them to determine what price they can pay us and what price, is a comfortable price for us to charge them. So prices are determined like that. In case of the infra sector, I told you that, when our modifier prices are lower than the bitumen prices, it helps us a lot because it increases the demand. Currently, petroleum products are quite high, and by adding recycled rubber, prices, the price of the end product actually comes down, which helps us in, with higher demand predictability. And in case of the consumer sector, you are competing with other people making similar kind of products, and it's a dynamic of, who's able to make it more efficiently and supply at the desired price of the customer. I hope that helps answer your question.
Yeah. Very much. Yeah. Thank you.
Thank
Okay,
you.
thanks.
The next question is from the line of Mr. Chidananda Mohanty from Green Portfolio. Please go ahead, sir.
Thanks again for the opportunity. So I have two questions. The first being, I think in Q1 FY26, you started importing tires from South Africa. So exactly how much tires have been imported in Q1? A quantified number.
See, how much quantity per month or per quarter, we don't feel...
Per quarter.
Yeah. We can tell you that on an average, about approximately 70% of our tires come from imported sources. By telling you exactly which source gives us how much is not, this is not the forum for us to discuss. That is sensitive to our business.
Okay, sir, no issues. So next question is that you mentioned that the ELT prices have been increased in Oman specifically. So can you give the reasons behind it, or exactly it increased in Oman only? Sorry, Oman.
If I've heard you correctly, your question is that the price of raw material has increased in Oman. Is that your question?
Yeah. Yeah.
Yeah. So that is correct. In Oman, subsequent to us making our investment, we have seen at least 3 new recycling facilities have also come up. As a result, the price of end-of-life tires there has gone up, putting some pressure on margins for the time being.
Okay. So the very last question. You previously have told that you are working with government of Oman to bring CRMD into Oman also. Any update on that?
Yes, it is work in progress, sir. They are still, doing analysis and testing of the road that we had, that stretch that we had laid for them. It is still an ongoing process.
Thank you. That's it from my side.
Thank you.
Ladies and gentlemen, that was the last question for this session. I would now like to hand the conference over to the management for closing comments.
Thank you, everyone. We sincerely appreciate your participation in this conference call and trust that we have effectively addressed all your queries. If you require any further information or have additional questions, please feel free to contact our investor relations team and Go India Advisors. Once again, thank you for your engagement and your interest in our company and continued support. Have a nice day.
Thank you, sir. On behalf of Go India Advisors LLP, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.